This year's trading environment has been a little trickier for investors looking to pick winning stocks with a big rotation out of technology in effect. So, what factors are playing into how the rest of the year is shaping up? Here now to discuss that and more is Liz Young. She is head of investment strategy at SoFi. Thanks for joining me today, Liz.
I'm delighted to be here.
So 2021 has been a very different year for the stock market than 2020 in terms of the groups that are working and seeing out performance. Last year was all about growth and tech, and now it's all about these economic recovery plays. So how much longer do you think this rotation is going to continue to play out?
Well, let's take a step back first. And 2021 should be different than 2020 in the way that it plays out in the stock market and the way that it plays out in the economy. What we were looking at in 2020 was really just a dire situation through most of the year. And by the end of the year, we had a little bit more optimism, obviously got into the vaccine news, and we started to look ahead and say, okay, the future might be better than the past. And then we got into 2021 and the data started to get better. So this is really the year where the rubber hits the road. And I think that's what the market is trying to work through. We're naturally going to go through a bit of a transition. And anytime you have a transition, there's likely to be rotations in leadership in the market, which is what we're seeing right now. And I think the rotation that's happening, number one, isn't bad for all the sectors. It isn't necessarily even bad for tech. Tech is still eking out gains over this period. It's just that the spread between what the big technology stocks had in 2020 versus the rest of the market is not going to be the same as what they see in 2021. But that doesn't mean that there isn't still upward momentum.
And yeah, speaking of that momentum, we're seeing more of that for the S&P, for the Dow, and definitely not for the Nasdaq. There's this bifurcated market going on. Do you think that that will eventually resolve itself? What are some of the things that you're looking at that might help indicate how that plays out?
Right. Well, first and foremost, momentum is a powerful force, and I would not ever suggest that somebody try to fight it. But one of the tricky things about momentum is that it can change course very quickly. It can change course on a dime. And it's really difficult, if not impossible, to call that inflection point. So what you really want to look at here is what are the parts of the market that are likely to do well as we recover and as we hand the baton from policymakers, so from fiscal policy, from monetary policy, back over to company fundamentals. And when I say company fundamentals, what I mean is earnings quality, right? Our earnings beating estimates, our earnings healthy, our companies healthy, are their balance sheets healthy, are their income statements healthy as we move throughout the rest of the year? And we need to hand that baton off. So as we look at what investors should think about and the ways that momentum plays into that market, I think as we move through the rest of the year, you're going to see this shift into more quality names. And the momentum in the broad indices can continue. But as I stated earlier, I mean, the NASDAQ is really a tech-heavy index. It holds a lot of those big tech names. So because there's not likely to be a huge spread between those big tech names and the rest of the market, you're going to see the NASDAQ struggle. Also, as you look at the 10-year Treasury and just interest rates in general, the NASDAQ is really sensitive to those interest rates. And as the 10-year Treasury rate goes up, we're on a little bit of a pause right now, but as it goes up through the rest of the year, which I would expect it to do, it's a little bit of a headwind for those big tech stocks as well.
And you mentioned earnings, and it seems like even with largely strong earnings reports, investors shouldn't necessarily bank on that to fuel the next leg higher for the market or even the individual names that they are playing, because the reaction to reports may not be in line with what seems on the face of it as seemingly strong numbers.
Right. Earnings season is always a mixed bag, and it can show really strong results, which it did this quarter. But the mixed bag then is what's the market reaction to that? And what I think investors really need to remember is that the market is looking at what things are going to be 6 to 12 months down the road. And when you get earnings reports that are already widely expected to be positive, the market doesn't really get surprised by that. So the market will change directions when it gets surprised. I do think, however, that we're underestimating earnings strength throughout the rest of the year. And there's a lot of talk lately about valuations and whether or not things like the S&P 500 are overvalued or overbought. And it's true that about 95% of the index is trading above its 200-day moving average, which you could look at as an overbought signal. But when you look at earnings and when you look at the multiple on the S&P and specifically the PE ratio, if you just take the multiple, let's call it 22.5 times, and extrapolate that out with an earnings expectation of about 180 to 182 per share this year, all it would take is for earnings to beat up to like 186, 187 per share. And that means the S&P is trading at a reasonable level right now. So if we beat on earnings, which I think we're going to do for the rest of the year, this is a pretty reasonable place for the market to be trading.
All right. And the market is trading clearly at very much higher levels than it was last year, which was a very historic year in many ways, attracted a lot of new investors to the market. And for those who may be basing their trading rules or even their ideas off of what was working last year, they may have been in for a rude awakening this year. So what are some of the things that newer investors you think should be thinking about in a market like we're in right now, which again is very different than what we saw last year?
Yeah, well, there's actually a name for that. It's called recency bias. And it's when you look at what's most recently happened and expect it to continue on into the future. We talked about this a little bit earlier. 2021 is a very different year than 2020. So number one, the market is going to react differently. Different leadership is going to take shape. So it's not just that different stocks are going to take shape, different stocks are going to lead this out, but it's also that when you look at just the magnitude of what happened in 2020, I mean, we had this huge fall off and it was the fastest decline in history. And then we had this enormous rebound off the bottom. The magnitude of highs and lows that happened in 2020 and even the day-to-day swings from high to low in 2020 are just not regular occurrences. So 2020 was really the exception, not the norm. And I think investors looking out ahead, even if they're new investors and haven't really had a lot of experience living through a full market cycle yet as an active investor, looking out ahead, the average return on the S&P annually is about 7%. And that's a good expectation. Now, we're not going to have every year kick out a 7% return, but on average, over, let's call it a 5 to 10 year period, you get about a 7% return annually. So making sure that you're setting your expectations properly is first and foremost something that I want investors to think about, but also thinking about having a diversified portfolio, because what led in 2020 was a very narrow basket of stocks, a narrow basket of names. And what you want to see in the market is a more broadened out strength. So you want to see strength from a lot of different sectors. You want to see it from different size categories. You want to see it from different names. And if you have a diversified portfolio, you give yourself a better chance to participate in all those different corners of strength.
Right. And one way that investors can diversify while still being a little bit more tactical is looking at some ETFs. There's pretty much an ETF for any theme out there. And of course, tracking all sorts of different indexes and using leverage funds, which of course are not for the faint of heart. But that's another way that investors can look to capitalize on some of these themes or different sectors that are working without having that individual stock risk and having to pick the winner of the group.
That's right. Yeah, that's exactly right. So ETFs are a really easy way to get low cost exposure to a basket of securities. And you don't have to take that single security risk or expose yourself to headline risk on a specific company or people risk on a specific company. And ETFs also run the gamut. So you can have ETFs that are tracking a very broad index and it's a very diversified portfolio of securities, or you can have ETFs that are targeted for a specific sector, a specific industry group, or what's actually been happening a lot lately is ETFs that are going after a specific theme. We actually have an ETF at SoFi that follows the gig economy. So if you look at ETFs that are following a specific theme or something that's a little bit more narrow in the market, what you can do is build a portfolio that at the core has a diversified profile, right? And you have broad exposure to all of the things that are the stock market and the bond market and everything that would qualify as a core of the portfolio. And then along the periphery, you can add to things or add pieces of it that express your views in a more specific way. So if you feel very strongly about social investing, for example, or if you feel very strongly about technology investing, or you feel very strongly about a certain part of the materials sector, you can express that through an ETF and you can move it around over shorter term periods and make it a little bit more of a tactical bet.
Yeah. So speaking of that tactical element, what's your advice for individual investors out there looking to get tactical over the next 3 to 6 months? What are some of the things that they should be thinking about?
Sure. So over the next 3 to 6 months, it's really the recovery story. It's the reopening story. And I want to also outline that there's a difference between a rebound and a recovery. What we've seen so far is largely a rebound. Once we get back to prior levels of GDP, which should happen about the third quarter of this year, once we get back to prior levels of GDP, then we create new organic growth and we recover and we make up for the lost time from 2020. So when we look at what the reopening story is, I think it's going to be a lot of the stuff that we've missed and the things that we were restricted from doing. So it's things like travel, it's things like leisure, restaurants, dining, everything that we can do out in the open. The weather is getting nicer. We can go do things outside. And I think people need to really make sure that they're exposed to that, because consumers also have a ton of money saved up because they haven't been able to spend it. And there's been a lot of stimulus that came into the system that hasn't been spent yet. So when we talk about that pent-up demand and that pent-up spending, when that starts to get unleashed through summer and maybe even fall of this year, you have to think about what are the things that you're going to spend your money on? What are the things that your neighbors are going to spend their money on? And those are the sectors that should do well.
Yeah, I think there's definitely something to be said for looking at the world around you and seeing what these trends are that are taking place. I mean, that could even be likened to the development of new technologies, and that is often correlated with stocks that take off, or products out there. What are some of these ubiquitous things that are happening? So we'll have to see how the recovery trade plays out. But Liz, thank you so much for your insights today.
Thank you.
Hi there. Thanks so much for watching Investing Strategies on our YouTube channel. If you want more executive interviews and analysis of key trends to watch, make sure you hit the subscribe button so you can stay up to date.